We say that corporate finance is about managing finance for companies, and corporate debt stand for companies. But corporate finance will also involve individual because all companies are owned by individual. So the themes of the course is wealth maximization as compared to profit maximization. So what we are trying to do is to capitalize company as the organization or conduit to achieve the target of wealth maximization. There are various forms of business organization that can be formed by a person as an investor, as a operator. He can form an informal business or formal business. The three types of informal business are the sole proprietorship, where there's only one owner, and partnership, where there can be up to 50 partners, and limited liability partnership, also with 50 owners. Then you can upgrade to a formal business. The difference is, in a formal business, you need to properly register with the company commissions. In Malaysia, there is a company commissions of Malaysia, and once you register there, you become a formal business, and you are called a private limited company or syarikat sendirian berhad. And as a requirement, a syarikat sendirian berhad must appoint a company secretary or to liaise with the company commission on a regular basis, and the company must also appoint an external auditor to audit their accounts annually. So every year, the company must conduct an annual general meeting and submit their um, uh, their accounts and report of operation to the companies, or rather to the company commission. So that make it a formal business. Three types of formal business: private limited company. This is limited to 50 shareholders in the company. Public limited company, unlimited number of shareholders. And public listed company, companies that are public and are listed on the stock exchange. So to start a business, you can start as low as 50 ringgit, form a micro business, register with the registrar of business, and you can start your business. And it's informal because you don't have to submit anything to the registrar of business on an annual basis. We discussed last week about an interesting exceptions of the Islamic finance, where in Islamic finance we allow an arrangement where we have a partner that can be admitted without contributing any capital, and this is called the mudarib. The mudarib is actually the entrepreneur that will be working in the company to manage the company, and he is given a share. He's given share to manage. As a reward for managing the company, and so this is the special arrangement under the Islamic finance. In the conventional finance, every partner that come into the business will actually be contributing capital. Right. Um, we discussed also last week about the problem with partnership. In partnership, you have up to 50 partners, and of course, not all the 50 partners can be participating in business. So you may have some inactive partners, and in partnership, this is called the sleeping partners. The sleeping partners is essentially the partners who are leaving everything to the active partner to manage. But in partnership, every partner is jointly and severally liable on each other's action. So you cannot allow your active partner a free hand, because you are personally liable on his or their action. And every year, sole proprietorship and partnership will have to declare their profit to the Inland Revenue, but the Inland Revenue is not taxing sole proprietor and partnership as a business entity, because for tax purposes in Malaysia, in some other countries in the world, for tax purposes, it is the individual owner or partners that are liable to pay tax every year. So all profit of a sole proprietorship and a proportion of profit from the partnership attributable to each partner will be included in the source of income or profit of the partners or individual, and they will be taxed every year, even though the partner or the individual does not get any return on the. Okay, so each individual partner is liable to pay tax every year on the profit of the partnership in the sole proprietorship, even though they didn't get any money from the business, because the business expand and use all their profit to expand the business. So in business, risk is an important factor.
Kenapa?
Pardon? Risk is an important factor. So each businessman or partner must try to protect themselves from the exposure on risk. For this to protect ourselves from the risk, a business owner must find ways to reduce their personal risk. So we could instead form a limited liability partnership, LLP. Can you see my screen now?
Yes, Prof.
Yes, Prof. Yes, Prof.
So a limited liability partnership is still a partnership, but for tax perspective, they are still you are still liable as a partner to pay tax every year, but limited liability partnership introduce the word limited liability, which actually protect your personal asset from being dragged into the business affair. So the tax liability cannot be separated, but liabilities of the shareholders from the risk faced by the business can be protected. That means if LLP is doing poorly in business and making losses, and the creditors cannot touch each of the partner because each of the partner has a limited liability, and their liability is limited to the amounts of shares that they put into the partnership. Okay, so to actually overcome the tax liability, a person must swiftly transform their business into companies, because companies has its privilege. A company is a conduit, just like other form of business, but a company is regarded as a separate legal entity, and hence a company in Malaysia is being taxed separately from the owner. So for the purpose of tax in Malaysia, a company is being taxed separately, and profit of the company is taxed on the company, and the company is then liable to pay tax every year. So it is the company that pay tax, not the shareholders. And a company is considered like a human being, like a living human being. A company can choose their resident status just like human being. Every one of us as a human being are given a choice of being resident in Malaysia or a non-resident in Malaysia, depending on our tax preference. Of course, there is always advantage to being a resident in Malaysia for individual and also for company. In Malaysia, for example, to enjoy tax incentive, a company must be resident in Malaysia. Right. So that's the background of the company. Then we talk about wealth. How do we magnify wealth in companies? Of course, first of all, business must be viable to survive, and viability of the business is based on the profitability and sustainability. And hence, we must know what is the profit margin of the business. Profit margin is the difference between selling price and the variable cost. So profit margin will depend on the types of business. A higher profit margin does not guarantee maximizations of profit. A low profit margin also does not necessarily mean that the company is suffering, because there are just some companies that is naturally have a low profit margin. Companies or a business like petrol station, wholesale, payment gateway system, and so on. So, but some businesses are basically developed naturally as a high profit margin business. This is business like the hotel, profit margin up to 95%. Professional firm, accountants, lawyer, engineer, dentist, and so on. Architects slightly low. Tourism also high, and so on. Okay, that's one aspect, profit margin. We need to know what is the profit margin of our business. If we are in the food business, we have a restaurant, our profit margin should be between 45 to 50%. If we are in the manufacturing business, our profit margin should be about 30%. If we are in professional business, our profit margin should be above 60%, and so on. That's very important to know, so that we can control our business. If our profit margin started to decline, if we are a manufacturer, and our profit margin has gone down from 30% to 10%, then there is some serious problem that we need to attend. Otherwise, we will have problem in the future. Okay, that's the first thing. Second thing that we need to control in business is the operating overheads, or this is also called the operating expense. This normally comprise of the wages and salary, the rental expense, utility expense, office expense, and finance costs. We need to know what is our monthly overhead. Overhead, from the term overhead, is a burden on top of our heads. And so every month, it is an obligation. By hook or crook, we need to be able to pay our monthly overhead. Another important overhead is coming from depreciation. When we incur capital expenditure, we spread this capital expenditure over the period of usage of those assets, and so we have a monthly depreciation. For example, this business has a total overhead of 76,000. It means that the business is having that obligation every month by hook or crook. They must try to generate enough profit margin to cover the overhead of 76,000. If excuse me, if the profit margin is 45%, this is, for example, we are looking at the case of KFC. KFC is recently having a lot of issue because of the boycott and so on. They intend to close hundreds of their outlet, and it is estimated that each outlet will have an operating overheads of 76,000. So we need to calculate the break-even point. Break-even point is what determines the viability of business. Break-even point is the minimum level of operation that will determine whether a business is viable or not. And break-even point is calculated simply by taking the overhead on top of our head divided by the profit margin. So if our overhead is 76,000 a month, profit margin is 45%, we divide by 0.45, then we see that every month we must generate a sales of 169,000. So per day, we need to divide that by 30 if we operate 30 days a month. So it is 5,600 a day, or about 470 ringgit per hour. So with that, we will be able to gauge, can we generate 470 ringgit per hour of sale? For example, if a piece of chicken is costing 5 ringgit, for example, so we need to sell 100 pieces per hour to break even. Okay. Now, if your actual sale is only 5,000 a day, then you know that the business is suffering a loss because the actual sale is lower than the break-even point. 5,000 minus 5642 multiplied by the profit margin give us the loss. So every month we suffer a loss of 200. Of 8. Every month we suffer a loss of 8,700, and per day we are losing about 300 ringgit. Okay. Just take another example. This is KK Mart. KK is a retail outlet that have over 400 outlets throughout Malaysia, and they are about to go for listing. KK actually do not have serious competitor in the market because they are 24 hours retail outlet, really selling all household goods. So they're not competing with 7-Eleven because 7-Eleven are selling junk food. They're not competing with Speed 99 because Speed 99 is only open 10 to 10. So they are a superpower in the market with 4,000 outlets. Even if their profit margin is only at 20%, which is very minimal. I mean, actually, their profit margin is a bit higher than that. With the monthly overhead of 68,000 each, for each stall, 68,000. We see that their break-even point is 341,000 or 11,000 a day or 475 ringgit per hour. Let's say that their daily sale is 20,000 a day, which is actually quite minimal. They are making about 30,000 a day, I think, today. But at 20,000 a day, their profit is 51,000 a month. 51,000 a month may sound small, but if you multiply that by 4,000 outlets, their total profit is 206 million a month. 206 million a month. Multiply that by 12. So, sorry. Their profit is 51,636 per 633 per month, and if we multiply that 51,633 by 4,000, it is 206 million total, with the 4,000 outlet. And if you multiply that by 12, it is 2.4 billion profit per annum. 2.4 billion per annum. I mean, this is something that we cannot imagine that KK Mart, even before going for listing, is already making 2.4 billion profit per annum. And let's look at the process of well magnification. And actually,
that's sorry, Prof. That is not sales volume, right? That's not revenue. That's profit margin.
That's profit. Yeah, this is profit. Yeah, this is actually profit. Total profit. Total annual profit. Yes. Okay. So now we look at the process of well magnification. Normally, listing is the process of exit for the shareholders. What it means is that shareholders have taken the first risk investing into the company, starting from scratch. That could be maybe 10 years ago. So now it is the time to plan for the return on investment. So investor or rather shareholder will plan to list the company at a premium price of listing so they can sell some of their holding to the public like us. So the public will actually have to bear the cost of risk and development of the company by paying the premium price. On the listing. Okay. So, for example, the company have a total of say 500 million shares outstanding, and they structure a listing by inviting public and corporate to invest in the company. So a new share will be issued, say another 1.5 billion. Some will be allocated to the corporate investors like PNB, unit trust, investment institution. So investment institution here will be buying some of this, and then there will also be a public offering. They call it IPO. Initial public offering or IPO, and this is maybe 500 million. So the sum will be allocated, say 1 billion. So we will see a new share of 1.5 billion will be issued to the public, and the investment institution. So we see that the new capital structure will be maybe the original shareholders is 500 million. Then the institution um, 1 billion. Then the public investor, another 500 million. So total a new share holding is 2 billion. Right. So in the corporate finance, the value of a company is not so much determined by the total asset of a company. For example, this company, though they have over 4,000 outlets, they may be renting all of it. So there is no fixed asset. Of course, there are a lot of equipment and fixture. But the value of asset can be, say, at the current market price, can be about, let's say, 200,000 each for each outlet. Or if we multiply that by 4,000, that's 800 million. Then the outlet has a lot of inventories. These are all goods. Yes, on the shelf. So this is worth about 1.5 billion. Oh, sorry, million each. So if you multiply by 4,000, that's 6 billion. But the company also have big liabilities. The biggest portion are owing to the suppliers, which because the credit period for suppliers by most retail outlets are between 6 to 12 months. So it is about about 2 million each. And so if you multiply by 4,000, that's about 8 billion. Okay, so you can see, and then they may have a bank loan on the equipment and asset, including renovation. This can be about at least 1 million each. So you have there 400 million. Okay, so if we say total asset, there is also bound to be cash, cash on hand, about 1 million. For each outlet. So it will be 400 million. Okay, so total asset, you have cash, $400 million. Then you have inventories. Inventories is 6 billion. Then you have some asset. We call it a non-current asset, which is um, 400 million. So total asset of 6.4 billion. If you notice why has the figure balloons into billion is because they have 4,000 outlets, and this is the power of compounding. If you start a stall, a small business, your total investment is only 4,000-5,000, but once you expand your business into 10, hundreds and thousands of stalls, then you are bound to expand the figure. And the total liabilities, your total liabilities will be
Prof, the non-current asset, not 800 million.
the 800 million is the equipment.
Value of
Yes,
asset.
yes,
So where
we
is
will.
that?
Yes, that is. Wait. Good point. Yes, it's 800 million. 800 million, yeah. 100 million, and so this is 7.2 billion. Then your total liabilities is uh, 8 billion. This is suppliers liabilities is 8 billion. And banks liabilities is 400 million. So total liabilities is about 8.4 billion. So you notice here that actually the bank, this outlet has a net asset of negative, but of course, if they will not allow this to be negative, so they will find some other asset in between to make sure that it is stay positive, but it will not be big positive. Yeah, so we are just showing here an extreme scenario where a bank, or sorry, an outlet like AK may be having a very minimal asset, but has another value which is more important. And what is this value? And the most important value of a company is the value is the ability to generate income, and the ability to generate income, and this is measured by the earning potential of the company. And the basic measurement is the earning per share. Earning per share is actually profit per share. And how do you calculate the earning per share? Is simply the net profit after tax, and we divide this by the number of shares outstanding. Okay. So based on the current number of shares, just now we calculated the profit. The profit of the company was 2.4 billion, 2478384. Two 478324. Is that correct? Two four 2478384. Okay. So this is the profit that they made currently. And currently, the number of shares that they have is 500 million. And that gives an earning per share of 2478384 divided by 500. So that's that is 0.0049. Actually, normally earning per share is calculated by cent in cent. So it is not in dollar. But this is something wrong by the calculation. Let me check again the calculation. Is 2478384 divided by 500. Yeah, it's actually
0.049.
0.049, or it is it's actually 4.9 cent.
Per share.
Okay. Now, what does that mean? It means that on average, the company generate profit of 4.9 cents per share. Is that big or is that small? Of course, this will depend on the expectation of the shareholder, but in the financial market, we have this perspective of price earning ratio. Price earning ratio or PER is the earning multiple of the company. So earning multiple determine how many times the EPS can be multiplied to reflect its current value. And how do you determine price earning ratio? PER is determined by the market based on the share price. Because for a non-listed company, the standard PER is 8 times. For listed company, we could use the industry average or the market average. The current market average is about 15 times. The industry average will depend. For example, 7-Eleven has a PER of 40. Okay. So this is where we need to play by ears, depending on the confidence of the market, the sentiment of the market, and we will determine the PER. We can calculate the PER of a company by taking the share price divided by the per share. Or EPS. So if we already have a company that is listed and we want to calculate the price earning ratio, we take the share price divided by the earning per share. But in our case, the company is not yet listed, so we need to use the standard. If we use the 8 times PER at 8 times of PER as an unlisted company, the share price share price is the EPS multiplied by PER, and EPS is the earning per share, and PER is the price earning ratio. So let's say in our case here, if the earning per share is 0.049 and the price earning ratio is 8, so we have the share price of 0.049 multiplied by 8, 0.392 per share. So the current market capitalization is market capitalization is equals to share price multiplied by number of shares outstanding. So in our case, the share price is at 32 cents, sorry, 392, and multiply that by 500 million share. One 392 multiplied by 500. So that's 196 million. This is the worth of the company today before the listing. So we are now going through the listing process, and the listing process is going to enhance our market capitalization. So market capitalization reflects the wealth of the shareholders. Okay, in a company, what matters is the shareholders' affair. It is the shareholders that we are trying to take care of, because the management are responsible to the shareholders. They report to the shareholders. So we want to maximize the market capitalization of the shareholders, and if we do this, then we can maximize the wealth, the wealth of the shareholders. All right. So in the listing process, in the listing process, just now we plan to issue 1.5 billion shares to institutional investors and public, and with the current outstanding shareholders of 500 million, so we will have 2 billion shares. With the listing, the number of shares outstanding will increase to 2 billion. Hmm. 2 billion shares. Now, the current profit is to just now, how did you get the? No, this is not right here actually, isn't it? This is not right because our net profit is 2.4 billion. Multiply that by, or rather divide that by 500 million. So it is actually in terms of ringgit, it is 4 ringgit 90, isn't it? Is that correct? So this is actually 490 cent. Okay, so there was a mistake there. So here the share price is
It's 495 cents.
Yeah, 490 multiplied by 8, and that is 490 multiplied by 8 is 39 ringgit 20 cent per share, and 39 ringgit 20 cent multiplied by multiplied by 500 million is 19.6 billion. Right. Okay, so the current profit is 2.2478,384. Okay, that's the current profit, and so the new EPS is 2478,384 divide by 2 billion. Right. So we have here the earnings per share is actually 2478,384 divided by 2 million. So that's 1.23912. So this is the new earning per share. Okay. So here, we will decide on the IPO price. The IPO price must reflect the current market price or the current market value. Of course, this should be higher than the reflect a higher price earning ratio than a non-listed company. If we use the average market PER, which is 15 times, then the share price or the new share price should be so this is share price is the earning per share multiplied by price earning ratio, and this is 1.2392 multiplied by 15. That is 18.57 per share. So that's at that the market capitalization is the share price multiplied by number of shares outstanding. So this is 18.57 0.58 multiplied by 2 billion shares. Right. 18 multiplied by 2 billion. So that's 37 billion 175,760. Okay, so this company today is going to be worth 37 billion, and this is the well magnification. The well magnification occurred when the market capitalization grew from 19.6 billion to 37,175 37.175 billion. Okay, this is what is happening with bigger company like Amazon, for example. Amazon was just a bookseller, and then they convert themselves into a retail outlet selling uh, anything under the sun. And today, at one point, Amazon has the biggest market capitalization in the world, and making the owner as uh, the the richest man on earth. Of course, then came Elon Musk that has taken over as the biggest, big or the richest man in the world. Right. Uh, so we start humble as a small retail outlet, but here we have magnify our wealth, and so this is the story that we are trying to always repeat in the business model. We start small as a small retail outlet. You could actually start with just a small stall selling, for example, goreng pisang. And if you start a small stall selling goreng pisang, your initial capital may be less than 1,000 ringgit, and you are perhaps selling 500 ringgit worth of goreng pisang every day if you are diligent. And then you expand your business. You, instead of managing just one stall, you create 10 stalls. And so every day, instead of selling 500 ringgit of worth of goreng pisang, you will sell 5,000 worth of goreng pisang a day. And if you multiply that by 30 days in a month, it become so we see the just going to show the well magnification process. No, sorry, wrong place. the well magnification process from a small stall selling, for example, let's be creative. We will look at the new product. Let's say you are selling, I don't know whether this is, let's say you are selling fried cucumber, and so you generate 500 ringgit sales a day. Then you capital initial capital of 500 ringgit, or just for the work and the burner and so on, and then you start magnifying by expanding the business into managing 10 stall, and hence collecting um, 5,000 sales a day, or um, multiply by 30, so it is now has become 150,000 a month. So this is you start with 500 a day, or you are selling 15,000 a month. And now it become 150,000 a month. And actually 150,000 a month is already credible. Of course, the capital required is now maybe 10,000. But your at profit margin of 40%, the total profit margin is the total profit margin per month is 150,000 multiplied by 40%, so it is 60,000 per month. Your overhead, operating overhead, basically you have two assistant per stall. So it is now 20 stall multiplied by 2. So you have 40 multiplied by 50 ringgit a day multiplied by 30 ringgit a month. So that's 40 multiplied by 50 multiplied by 30. So that's 60,000. Wait, is it true? Let me calculate again. Doesn't make sense. Is 40%? No. Yeah, it's 40% multiplied by 50 ringgit multiplied by 30. 60,000. Seems that there is not enough margin to cover here. So you cannot sell just 500 a day. You cannot sell 500 a day because that's not enough. Let's say you sell 800 a day. So if it is 800 a day, multiply by is 24,000, and if you are doing 10 stall, you will have 240,000. And that's your profit margin. No, 240,000 is your sale. So at the 40% profit margin is to 240 multiplied by 0.4. That's 96. 96,000. So your overhead is it's actually just this, and all the 40% has taken into account all the variable costs, yeah, the raw material, oil, the gas, and so on. So you may just add another, say, operating expense. You expect there could be some additional expense on each stall. Let's say you expect there is currently 10 stall at 2,000, so you have 20,000, 10,000, 1,000 per stall expense. So your total operating expense is 70,000, and so your operating profit is your the you can prepare quickly the income statement. Projected income statement, the revenue of your revenue of 240,000. Revenue of 240,000. And your variable cost is 60%. That's 144,000. So your profit margin is sorry, this is actually 86,400. Two 40 minus 86.4 is 153,600. That sounded like something is not right. Let me calculate again. 240 multiplied by 0.6 is 144. Yes, I was correct just now. It's actually 144. Yeah. Okay, so it is 240 minus 144 is 96. So your operating margin is 96,000. Your operating overheads is 70,000. So your this is 26,000, and this is actually per month. So your annual operating profit is 26,000 multiplied by 12, so it is 312,000. So actually, in 1 year, you have created a credible business that generate 312,000 per annum. All you need is to expand it further if you expand further and have, say, 100 outlet, then immediately you will create 31 million business. This is in the form of just operating profit. No? Okay, so this is how the first level of wealth magnification, and from this wealth magnification process, you go into listing process, and that is the second level of magnification, wealth magnification. Any questions or comment? Questions or comment?
So far, no, Prof.
Right, that's good. Do you have any question on the note that I sent you just now? No question? Right. We will continue. We will now, so we will close this topic on wealth magnification. Essentially, we can conclude that you can start your wealth magnification as small as possible. All you need is an ambitious mind and an effort to move toward it. Think of how you can start a very viable project. Just one small stall as your pilot project experiment, and then expand it 10 times, 100 times, and then you are ready for listing. All right. Now, we want to move to a related topic, but new topic in the sense that we are looking at capital budgeting and investment evaluation. Okay. As a background, when you look at an investment opportunity, everything seems to be attractive. But the issue is whether it is really viable. And viability here must be really closely evaluated based on the financial perspective. For example, an associate came to you and offer an investment opportunity. Said the initial investment is say 100,000, and you happen to have some money in the bank somehow, and so you are anxious to invest because you think that you are wasting your resources leaving the money in the bank. So, and the return on investment promise to you is that every month you will get a return of 12,000 for 15 months. This sounds like a very good investment, isn't it? The return is 12,000 multiplied by 15. So that's 180,000 over 15 months. I mean, if you calculate the rate of return, it is um, 180,000 minus 100,000 and divided by 100,000. So it is 80% return in 15 months. So most of us will jump into this opportunity. We will normally jump into this opportunity and tell others that you found yourself a gold mine. But is it really a gold mine? Of course, this is subject to the evaluation. And what evaluation do you want to make on this investment proposal? Number one, you want to know, is this investment genuine? And what do we mean by genuine? Genuine here means that we know the the operator, we know how they make money, and we establish that everything is legitimate. And we need to know the risk level. What is the risk level? What risks are we taking on this? And there are many risks, of course. There is the risk of losing the investment, risk of not making profit, risk on the monthly return installment. There are so many other risks that you need to take into account. And then we need to also establish what is our cost of fund. Even though this is our own money, but there is still a cost to our fund. As in business, normally it is said that there is no such thing as free lunch. Everything has a cost. So we need to cost our fund. So if it is our own fund, it is lying idle in the bank, then we need to know the opportunity cost of the fund. What is opportunity cost? Opportunity cost is the alternative investment, alternative potential investment return. So if this money had been invested in another project, what kind of return can you expect? Of course, this can be something tentative, imaginary, because until you really invest in a particular project, you will never know what is the return. So that's why we need to establish, for example, how well it is the guaranteed monthly return. Okay, talking about this opportunity cost of fund, well, how so we need to establish how do we calculate this cost of fund. Normally, cost of fund can be determined by taking into account several aspects. One, just now we talked about the opportunity cost. Next, we talk about the risk profile. Next, we talk about the inflation effect. And we also need to take into account the sacrifice in postponing the enjoyment of the fund. If you have 100,000 in your bank account, at least, I mean, if you don't do anything, you would have a pleasure of looking at your balance as a bank statement every day, that you have something there in the bank ready for you to do anything you want in the future. You can go for a holiday with it, you can get married, you can buy a new car, you can pay for a deposit of house, anything. So you need to take into account all this. So we say the opportunity cost is the alternative investment. So you need to essentially take into account what will be the normal rate of return if you were to invest outside. Let's say put 8%. What is the risk profile? And risk profile here we talk about the risk that you are taking investing in this, the probability of losing money. Let's say you put 2% there. Inflation, this is the effect of shrinkage in money. So your 100,000 that you put there is definitely not worth the same 100,000 50 months from now, because its purchasing power will reduce and you may not be able to afford the same thing you can afford today. So you need to take into account that, for example, is 1.5%. That depends on the inflation rate in the country. Sacrificing, postponing, this is something very relative. Let's just put a small 0.5%. So your total cost of fund is 12% per annum. Now, in the case of company, a company that intend to invest in a project can cost their source of fund by using what is called as the weighted average cost of fund. This is WACC, weighted average cost of fund. What is weighted average cost of fund? Is um, the cost, the weighted average cost, or the average cost of the various source of funding in the company. And in a company, we have several established sources. The first source is, of course, the share capital. This is normally called the ordinary share, or also called as the common share. How do you calculate this? We will be going into this valuation later, and we'll go into each of this cost of fund. You will also have bond or sukuk, or essentially this is called the instrument, and there is another class of shares which is called the reference shares, also called the preferred stock. Same thing as preferred stock is the American terms. Reference shares is the English term. Then you have the bank loan. Bank loan, also there is several class of bank loan. There is overdraft, which is the most expensive form. So we can take the weighted average of each of these source of fund, and normally this is calculated by taking the rate, the volume, and the cost. Okay. So we will normally calculate what is the rate. For example, on ordinary share or common share is normally the highest. because it is the most costly. And why it is most costly is because expectation of the shareholders is always the highest. Preference shares is normally stated on the certificate, the cost. The same thing with bond and sukuk. Bank loan is relative in the middle there. Overdraft. Right. So, and then we take into account how much of ordinary share do we have in the company. Let's say 200 million there. Preference share 50 million. Sukuk or bond 30 million. Bank loan 80 million. Overdraft, we should not be using overdraft carelessly. So as minimum as possible. And need more spacing so that I can write. The cost here is the cost per annum. When you multiply that, 200 million by 0.18. $36 million. This is 12% of 50 million. 6 million. Uh, 3 million. $4 million. $1.8 million. Now we will total. I'm so sorry that we are using all the big figures this morning. Just I it doesn't it's not meant to cluster your thinking, but because we are doing corporate finance, and in corporate finance we are looking at a company, and companies are bound to be relatively bigger than sole proprietorship or partnership. $36 plus 6 plus 3 plus 6.4 plus 1.8. So 53,200. So the weighted average cost of capital, WACC, is actually calculated as 53,200,000 So it is 14.7368. This is a percentage. Right. So this is how we find our cost of fund. Now, having got your cost of fund, then we need to determine now the investment viability analysis. One very important aspect here is the elements of cash inflow and cash outflow. And essentially what we are seeing in long-term investment, instead of using return on investment, we just take into account cash inflow and cash outflow of an investment. So we need to know how much cash outflow and when. This is important. Some investment may have to occur several round or several phase. So we need to take into account when it needs to be disbursed and how much. So for each of the disbursement, then the same thing, we need to know how much cash inflow and when. So when cash inflow is expected in and how much. These are the two important factors that needs to that will determine the viability of the project. It's no longer about profit and loss, because profit and loss is taken into account indirectly, and in business we say that cash is king. In business we say that cash is more meaningful. Right. That's the first thing. And the second thing on the investment is we need to realize the time value of money. What is time value of money? Essentially, time value of money means money today is better than tomorrow. Next next month, or next year. So how to reflect this in the calculation is to quantitatively measure the different timing in cash inflow. So we will introduce the perspective of present value. Present value analysis essentially is an analysis that convert all future cash flow, taking into account the timing. Normally, we will only do the timing analysis on an annual basis. Of course, if you want, we can also do it on a monthly basis, but it is more cumbersome and the reward may not be that much different. Right. So time value of money needs to be introduced, and time value of money is taken into account by discounting the future cash flow. When we say future cash flow, this include the inflow and outflow both. Yeah. Uh, by discounting the future cash flow, inflow and outflow, using the cost of capital as the base. So we need to uh, we need to um, we need to determine the timing of each cash inflow and outflow. We then determine the discount factor. So the discount factor is calculated is basically 1 So discount factor for year 1 is this 1 over if R is the cost of capital, that we calculated just now, That is 14.7368. Let's take 14%. 14%. And discount factor is 1 plus 0.14. $1.14. One divide 1.14 is 0.8772. Factor for year 2 this is actually 1 plus half multiplied by 1 plus half. So when it is for 2 years, you have the denominator as 2 so it is 1.2996. So we have 0.7695. So you will go on calculating the discount rate for year 3 as one point one four, 1.14, 1.14. So that's 8. 1 divided by 1.4815 is 0.6745 or 6750. So you see, here is the discount rate. Then you can calculate discount rate. But there is a this is called the present value, and we have the present value table. And present value table present value table is actually available on Google. If you go to Google, then you can just Google for present value table, and immediately you will have a table here. The present value table, which you can download. I will try to download also, or I will try to copy. Try again. Okay. Copy. Hopefully, I can copy it so that I can give it to you. No, sorry, I cannot copy, but I can show you how we will use this present value table. Essentially, this is the table, and the table is showing let me, I don't know how to make this bigger. Okay, so if you can see this table, maybe I should go back. Yeah, this is the table. Okay, you see here on the row is a year 1 to year 30. On the column is the rate, 1% to 15%. So, for example, our project is the cost of capital is 14%, and it is for 15 months. So it is first year 0.8772, second year 0.7695. So we can actually just use that. So we say that the discount for 1 year the discount factor for year 2. So discount factor for year 1 is 0.8772, and discount factor for year 2 is 0.7695. So notice that this is the exact figure that we calculated here. So actually this is an alternative to the calculation. Calculation is much better if you have the time, because at least you are in control. You don't have to rely on Google and so on. Then there is another one called cumulative present value. Cumulative present value is another table that you can also get here. So if you search for cumulative present value table, you will have another table. Doesn't seem to be appearing, but one is the cumulative table. Right. We almost time, but I will try to get the present value table to be inserted in the notes so that I can give you both the present value table and the cumulative table. The difference between the present value and the cumulative is cumulative present value table is for annual cash flow that is consistent. Consistent means it is the same in value every year over the future year. So because it is the same every year, we will use cumulative table. If it is different every year, then we will use the present value table. But the idea of using this is to determine the discount factor, and the idea of having the discount factor is for us to then try and calculate here. So here we have that we have the first year cash inflow is 120,000, and the second year cash inflow is 30,000, or 50,000, and this we will multiply by 0.8772, and the other 50,000 we will multiply by 0.7695. And so we will get the present value. And the present value is 120,000 multiplied by 0.8772. So it's 105,264. And for the second year is 50,000 multiplied by 0.7695. So it is 38,475. So total present value uh, 105,264 plus 38,475. So it is 143,739. And initial investment $100,000. So the net present value is 43,739. So this is after taking into account the time value of money, the net present value is only 43,000 instead of 80,000. But it is still a viable investment. The investment generate a net present value of 43,739 after taking into account the cost of capital at 14%. So that's our conclusion. I mean, next week we will work on a longer project for 20 years, for example, and see how this net present value will play an important factors in determining viability of investment. Okay, let me sign off and give you this note. Right. All right. Thank you very much, and we'll meet again next week.